a lot of investors out there think they could pick the unicorn, the great deal versus the others. And I've been doing this for many years. I can't. The deals that we go for, they fit our criteria and we feel really strongly about them. But, I can't pick the unicorn.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name's Randy Smith, and I will be your host today. And I'm really excited to have Gary Lipsky on with us today. I met Gary through a mastermind that we're both a part of and saw him at a bunch of different conferences, brings a ton of value to the space. Gary is the president and CEO of Break It A Capital. He's purchased $250 million worth of transactions. He's got 1,300 units, given $23 million in distributions. He's the co-author of Best in Class, and he's also got a podcast, the Real Estate Investor Podcast. So, Gary, welcome to the show. Really excited to have you here.
Yeah, thanks for having me, Randy.
Awesome. Well, why don't we just go ahead and jump right in? Gary, can you tell the audience a little bit about yourself and how you found this amazing space?
Yeah. I've been an entrepreneur my whole life and wanted to be in control of my destiny. I've had kind of a winding entrepreneurial career, from restaurant delivery service I started in college to co-producing 3 low-budget independent films in my 20s. I started an outdoor ed, leadership development, and after-school company. And we were serving 9,000 students throughout Southern California by the time I sold it. And I had been investing in real estate since 2002 and started investing passively. I still do to a little bit of extent, and then became an operator myself over time.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Fantastic. Okay, so that's a very diverse background, obviously. I'm intrigued about helping the 9,000 students. And looking at your profile on LinkedIn, I see there seems to be a theme of helping and adding to the community. So I'm curious, was that kind of a normal transition over to multifamily, or what kind of spurred your interest into moving into that space?
So it was when I was growing up, I was working out at the YMCA, and one time the programmer saw me there all the time. And so she comes up to me and my friend one day, like, my instructor didn't show up. Can you teach sports to kids? And we're going to pay you for it. We're like, sure, sounds like fun, And so, one class led to like multiple classes, like booked up, but like it was always filled. I really enjoyed it. It was fun. I didn't, think about it much further, but down the road, when I was working on some film stuff, I was in between gigs, and a friend of mine introduced me to a school. They said we needed a lifeguard. I said, I got a lifeguard for you, and went out and hired a lifeguard through Craigslist, and just started doing sports programs for schools. And it just grew and grew and grew to, we had over 700 employees and about 700 independent contractors. So
unbelievable.
Yeah. And it's still running now. I'm really proud of the work that we did. But I had been doing it almost 15 years and built up a really good team. And it was a good segue into real estate because I had like 90 different properties. I had 90 different schools we were working with on a daily basis. We had regional managers. We had a team on site running programs, and we had to review the financials all the time and visit the properties and whatnot. So I didn't know it, at the time, like I was going to have all these different multifamily properties and whatnot, but it was a really good, training ground,
Yeah, no doubt. It sounds like very similar to what you're doing today, just different output on the back end of what you're doing there. So you also mentioned you did some films as well. So tell me about that a little bit. I did not know that.
Yeah, yeah. So it was a great experience to learn how like there's you have to make the day. You have to film what you have to film. It's very an entrepreneurial like you've got to find solutions, and there's no and ifs or buts. You gotta figure it out. And so I was I started off as a PA, production assistant on some films, and then I had, I just said, why not? Why can't I do it? Just like anything else. And so I
Yeah,
wrote a script with a buddy of mine. We did a video clip. We sold some foreign rights, and we raised some capital, and we made a film. I co-produced two other films as well, and
yeah.
it was a really good experience, but not something I wanted to do, for the rest of my life.
Yeah. Yeah, very interesting. And so you raised some capital in that process as well. So the whole time there's these building blocks that are leading to what you're doing today, right?
Yeah.
Yeah. Very cool. So now you mentioned that you did some passive investing early on.
Yeah.
And did you own properties as well, or was it just passive investing? What did that look like?
Yeah, I owned one of my previous houses. We moved down the block and turned it into a single family. And even the houses that we owned, we would do some value add to it. I was always looking at growing neighborhoods, being in the path of progress, and we opened up the kitchen, converted the office into a garage, and I was getting rental income because even like the first house I bought was. I looked at it as an investment, not like a forever home like our parents would, and no money down. I had debt and figured it out and made it work, and was able to grow my net worth through these little investments, and then started investing in some of other people's deals because I wanted to see what they were doing, what they were doing right, what they were doing wrong.
Sure. Yeah, that's interesting. So I kind of had a similar journey. I started buying single families out of state, and then I started passively investing to kind of peek behind the curtains to see if I wanted to get into the syndication space at some point. And I found out very quickly that syndication is not all rainbows and unicorns. It's a lot of hard work. There's like true professionals that are working their butts off to make sure that these investments go well, not only for the investors, but also for the tenants as well. And, kind of fast forwarding a little bit, it looks like you really kind of made a name for yourself in the asset management space and ended up writing a book on it. And I heard somebody this last week that said, the acquisition piece, that might only be 2 or 3 months on the front end, but asset management is literally 4 to 6 to 10 year process on the back end. So yeah, can you share a little bit about kind of your experience as you moved into that operator space and why or how you developed those asset management skills?
Yeah, I realized my strength was running businesses.
Cool.
I've been doing it for 30 plus years, and so that made a really good transition into real estate because I could apply those skills. So I didn't have the like real education on how to do it, but we built out some basics through Excel and whatnot, how to track things. What gets managed, what gets measured gets managed. So that
Yep.
we knew that we knew some basics, and we just keep improving on what we were doing, and felt that we were pretty good at it, but wanted to really hyper speed our education. So my partner and I at the time decided to do a podcast on asset management, and so we'd bring on people that we respected and wanted to learn from, and that really helped us gain a lot more knowledge as well. And so then we're like, well, there's no book out there. Let's write a book. Certainly, I had imposter syndrome, in the beginning to be like,
Yeah.
who am I to write this book? It took a few months to like let it marinate in our heads on how we'd approach it, but we felt like we had a very it's a lot of hard work, but we kind of simplify it for people, make it like asset management 101, and that we could share those things. And it really was a great place in the market because no one was talking about it. And I don't think there's a conference I go to that people don't come up to me and say, "Hey, I learned so much from that book."
Yeah.
Because no one's teaching the basics. They'll teach you how to get your first deal. And so it really became a nice calling card for us.
Yeah, and I think like for the new investor that comes in, they hear, and I'll just speak for myself. When I first heard asset management, I thought property management, but that's not it at all. So, can you kind of share with the audience what the difference of the two is and why asset management is so important? Probably even more important today than it was even just a handful of years ago.
Oh, absolutely. Absolutely. Years ago, you just buy a deal and you can go to sleep and it's going to go up. But really, the asset management piece is a huge differentiator. And so, your property management company, and it could vary with a small property, maybe there's not an on-site person, but with it, let's call your 100-unit property, you have a full-time property manager, you have a full-time maintenance tech on that property. They're managing it from a day-to-day basis. Then you've got your regional manager. But at the end of the day, they're 9 to 5. They'll deal with the problems on site, but as an asset manager, you're in charge of executing that business plan and making sure the property management team is on the same page, setting expectations, holding the team accountable, making sure you're hitting your occupancy goals, making sure delinquency is where it needs to be. No more. Making sure you have enough capex, checking the financials on a weekly basis and a monthly basis. There's a lot of work that goes into it, and I think people starting out don't really pay attention to it. They're in the focus of doing deals and fees and more and more and more and more. But it starts with the foundation. If you have a really good asset management team on a property, your chances of success have 10x the probability.
Got it. Got it. Yeah, no, that's thank you for walking through that too. There's a lot more to it than just getting people into the units, making sure that everybody's paying their rent. There's so much more to it. And you play in the value add space as well. So this idea of buying an asset, letting kind of rents increase just organically because of, prices are just going through the roof. That's just not really going to happen anymore. And you've really got to execute that business plan and renovate units and increase the make it look better outside to attract foot traffic and all of that kind of thing. So yeah, very good. Thank you for walking through that. I think it's a piece where we see, or we're probably going to see a lot of folks get stuck here in the next couple of years because they didn't focus as much as they should on the asset management. And we're hoping for, just kind of the layup like we saw for a lot of years in the past. So let's take a step back if we can. Can you talk about that first purchase that you made and what that looked like? It's I would imagine is a pretty scary time, and you said imposter syndrome before. I would imagine imposter syndrome definitely played into that first purchase. So what did that look like?
Yeah, we bought a 42 unit for 1.65 million in Tucson, Arizona. At the time, we should have just bought the whole neighborhood,
No
at
kidding.
those prices,
No kidding. Yeah.
But the beauty was I had two people that I had a lot of respect for and brain power. So we're able to share our nervousness together because we had all these different people looking at it
Yeah.
and helping with it. So that helped us, and we knew we raised $1 million. So just a small deal, easy pickings. Talking about asset management, the owner on this deal, I don't know, probably hadn't seen it in years. They had the wrong phone number on the wall for
Oh, no.
leasing, which was awful. Like the paint was chipping off. It was just in really bad condition. And we raised the rents probably about 50% to
Wow.
market. And almost all the residents stayed because it was still very reasonable and we were offering them
Sure.
a better product. So the owner could have infused some money and did this work, but they fell asleep on this deal, which we find time and time again. And so it was just a tremendous opportunity for us.
And how long ago was that? Was that 2017 or was when was
That
that?
first deal was May 2019. Um,
2019.
yeah, so
Okay.
the first couple of years, even I got in this space, it was just learning and writing deals, getting reps, which is important. Just underwriting, putting in offers, visiting properties, and gaining data points so we can know what's a good deal and what's not a good deal, babe, because we've gone through it, and
Yeah.
either we were too low on offers or didn't understand the market. But over time, we were
Yeah.
developing a skill set. We were, you're being told to like kind of and learn to enjoy the process, and that's what we were going through.
So were you actually underwriting assets yourself, or did you have somebody on the team that was doing that? Or
Oh yeah, we were both, underwriting deals and looking at deals, and heck, we would drive out to Arizona from LA at 4 o'clock in the morning, come back at midnight, and
unreal?
just doing the work, and just learning all these different things and going to conferences and meetups and whatnot and sharing ideas and hearing from others, and that was a big learning process. And still, in order to stay on top of your game, you got to stay in that kind of growth mindset and learn.
Yeah.
I could learn something from someone just starting out just because they have a different take on something, or someone that's been doing it for years. So going to conferences, I was just at a conference last week. I'll go to a conference next week is really, really helpful to see what other people are doing.
Okay. So now that 42 unit, do you still own that, or did you sell it after a short while, or
Yeah,
what happened
we
with that?
we sold that within 2 years. It was 1.7x to investors. We finished our business plan, and so what we did was we came up with like a platinum level to 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 have more meat on the bone for the next buyer.
Yeah.
And a small property, it's hard. You don't have the economies of scale. So we knew we had, once we executed on our business plan, we knew we it was time to get out, and the market
Time to
was
sell.
great. So
Okay.
yeah.
And so on a 42 unit, that seems a lot of people aim for that 100 plus because of on-site property management. But how did you guys manage the property management with that? Are there groups out there that look for those size assets, or was that a challenge?
Yeah, we worked with a group that was able to handle that kind of property. But we had a part timer, and so we had a lot of turnover
Hmm.
because someone was always looking for that full time job or whatnot. So
Yeah.
that's the problem in that space. There's certainly a lot more opportunity because you have less buyers going after those deals, but you do lack economies of scale. You have a higher turnover issue. So a lot of people will start off on the smaller side and then try to get to those bigger size properties.
Got it. Okay. And so now today, fast forward, you've got 250 million in acquisitions. So started with a 1 point something, just call it 5 years ago max. And now all of a sudden you're not all of a sudden, but 4 or 5 years later, you're 250 million and you're raising in a fund structure today, which is very different than single asset raises. So can you talk a little bit about what that looks like as well? Because that's as a passive investor, I look at funds generally as more diversification, probably more stable returns, maybe a little bit more conservative returns, and possibly a longer hold period. But are there any other watchouts or benefits that you think the investor gets out of working in a fund environment or investing in
Yeah,
a fund environment?
yeah, definitely the de-risk. And I think a lot of investors out there think they could pick the unicorn, the great deal versus the others. And I've been doing this for many years. I can't. The
Yeah.
deals that we go for, they fit our criteria and we feel really strongly about them. But I can't pick that unicorn. Um, and what's important for us is every person's fund may be different, but it's always been quality over quantity. So just because we're raising a fund, we're not going to just pick deals just to do deals into our fund.
Yeah.
It's a matter of that's why we only pick 3 to 5. So it could be small if we just don't see enough good deals out there. Certainly
Hmm.
right now you're not seeing a lot of deals trading, but de-risk I think is the most important thing. You're still going to get your bonus depreciation, your cash flow, and it's 1 ppm for all the properties. You don't have to fill out, if we do 4 deals, 4 PPMs. And, I know for someone that's done, PPMs before, it's, they're long, you got to read it all. And then, you've got questions probably too, because every PPM is slightly different. So you get 1K1 versus like 4K1. So there's definitely a much better ease to it to a regular investor. But I think sometimes if they've typically invested 150,000, they may invest 150,000 in the fund. I'm like, well, it's 4 properties.
Yeah.
So a lot of investors are like, as we add more deals and spread it out, they'll bring in that extra money over the course of time because they don't have all that money up front,
Okay, so they can actually they can invest multiple times in the same fund to.
Yeah. It
Interesting.
all depends on when you do like the capital call, because we said we'll probably call most of the capital, and this is the good capital call, meaning,
Yeah.
we got a deal under contract, we're calling your money now to fund it. We're not gonna take your money and then just sit on it. When we have a deal that we really like, then we'll call your capital, we'll invest in that deal. And so there's a lot of different ways that we can work with investors so that we're always looking for win-win scenarios that fits their investment thesis,
Yeah.
and it works timely wise with us as far as having a deal.
Yeah. Yeah. And I think there's some value too. I think you would only get 1K1 as well. Is that correct?
Yep.
So they're
Yep.
they're combined. And I'm in 20 plus deals right now, and tax time is absolutely crazy.
Yeah.
And my goal is to get to a point where I've got, I don't know, 4 or 5 operators that I know, like, and trust, and then write much bigger checks, potentially in a fund model. So I still get the diversification, but decrease the administrative of the PPMs and the K1s and all of the challenges that brings along. Because I'm finding that is that's a part-time job in and of itself, just tracking all of those investments and all of those things. So, well, let's kind of shift, if we can, into, today we are talking in October 2023, very different market even from 2022 of October, even 21 and 20. So, like, what are your thoughts on where the market is? Is now a good time to be investing in multifamily, or would it be better just to throw it in that high yield savings account that I keep hearing so much about?
Yeah. So we're going to close on a deal, the first deal we've done in a year. So it's been, not a lot of deals on the market. There's a huge gap between what the buyers want and the sellers want. I mean, we put in offers on a lot of different deals, but we were 2 million, 3 million, 4 million below what they wanted. But now I think is a really good time. We know that, maybe they'll raise interest rates one more time this year, but something's going to break, and something has to give. If you look at the macros, next year they're going to be lowering rates, and they have to lower rates. You've got a ton of debt that needs to be refinanced. A lot of, the Fed has so much money that they need to refinance as well. And so you've got a ton of debt coming due. Things have to change. You're going into an election year. And so we feel like this is a really good buying opportunity. You're seeing 20 and 25% discount on properties. You can always refinance when rates come down in a year or two. You won't necessarily get that discount next year. There's a ton of dry powder waiting to pounce on multifamily. A lot of people are moving, billions and billions of dollars from office space into multifamily because they see that there's so much opportunity in multifamily. Everyone needs a roof over their head. There's a lack of supply. The people need a lot less office space. So, I think people will be looking back at this time and wishing they bought a lot more.
So, and I would agree. If it was a great deal last year at 20 million and this year it's at 16.5 or 17, then clearly it's a good time to be buying that asset. Now, I hear a lot of operators talk about buying today and the refinancing in the future, and quite often those same operators are using fixed rate debt. So, if you're buying with fixed rate debt, doesn't that take the option of refinancing off the table for a number of years? Or
that's a great question, because on our current deal, we have a 3-year fixed debt. So it's a higher rate, but no prepayment penalty. And so it gives us the flexibility of refinancing or selling. And if I took 5 year, 7 year, 10 year debt, I might be paying 2 million, 2.5 million on a prepayment penalty. I've
Yeah.
done it before on a deal I sold a few years ago. But knowing now, like finding debt that matches your business plan is so important, because I have tons of flexibility, as we execute our business plan, but I'm protecting our investors as well.
Okay.
So it's the best of both worlds. But I've certainly had investors and other people push back, and I've had to kind of walk them through our thinking. And it's not like we just looked at one option. We underwrote 20 different options of Fannie, Freddie, CMBS, all these different types of loans, and this made the most sense for our deal.
Got it. So you do a 3-year fixed, or is it a bridge with a rate cap that you're doing, or is it a 3-year fixed?
No, I bought the rate. I think it's like a point to lock in the rate for the 3 years.
You did. Okay.
And it's a higher rate, but when you look at all, it's low fees. I've worked with them before, easy to work with, and so when you factor in all these different things, this was the lowest cost that fit our business plan. That gave us some optionality, and if rates go up, we're covered. If rates go down, we're covered. If we want to sell, we're covered.
Yeah. And so you're betting that interest rates in 3 years will be lower than they are today, which we all hope they will.
Right.
Yeah, it's interesting. So yeah, there's a lot of folks out there that are playing, this floating rate debt with fixed rate caps. And then there's this question comes up, like if you're doing a true value add and you're driving increased rents, sometimes $200, $300, $500 per door with renovated units. Like, have you done calculations to figure out like how much NOI do you have to increase if you're seeing cap rate compression, or not cap rate expansion, I guess? Like how much NOI do you have to generate in order to offset potential increases in cap rate? Do you do those type of calculations, or?
Yeah. I don't remember the numbers offhand, but yeah, we take our model and we just try to break it in a lot of different ways whenever we're looking at a deal. So try to find our blind spots, and how if rents don't go nearly as well, if occupancy doesn't go as well, we want to find different levers to see where it ends up, and we'll always underwrite conservatively. I'm not going to have the highest IRR, but our assets are de-risked a lot more than others, and we put ourselves in potential for the highest upside on our deals as well. And I think that's what you want to look for in an operator. And on average across our portfolio, we've averaged an NOI increase in the first year of 40%, which is huge. Because we're finding deals with tremendous value and we're executing on our business plan. So we're safeguarding that asset. So even if things go sideways, we've increased it tremendously.
I think I heard you share in I don't know if it was a call or in a conference call we were on, where you shared like literally just moving over to low flow toilets and faucets can put like $1 million in value to an asset. Is that
even more? Because we have a 256 unit property under contract. They don't have any low flow. Their water bill is more than twice as high as similar unit property. On the conservative end, from the plumber, we'll save $138,000, and in the first year. Divide that by a 5 cap. That's $2.75 million that we'll be able to create. Really, from as soon as we take over, we can do the whole property within 6 days, and going forward, that's almost $3 million in value. It's crazy.
So you literally could do that one piece and sell the thing in a year and create $3 million in value just from that alone. That's amazing. Yep. That's amazing. Yeah. I heard somebody once say multifamily or commercial real estate is the only place where you can take a can of paint like reserved and numbers on parking spot and create $1 million in value. And it really is little things like that your asset management, your business plan, if you can just maximize every single dollar you're making from this investment, it just drives tremendous value to the investors. So yeah, very cool. Thank you for kind of walking through that. Now, I know you're focused primarily in Arizona as well. Is that correct? Or do you focus on any other markets?
We've been looking in Albuquerque and Vegas and Denver over the last year and a half and built up thousands of data points, but we've only bought in Tucson and Arizona, so Tucson and Phoenix so far.
Okay. So we're seeing a lot of headlines about rent reductions, year over year rent decreases. I have my own opinions about that, but I'm curious, how do you answer to that, or what are you seeing in your assets?
In Phoenix, yeah, you're definitely seeing higher vacancy, a little bit more delinquency, more concessions. But if you underwrite for that, then you're fine. If you were really aggressive, then you're going to be in a heck of a lot of pain. But as long as you know your market, and you underwrite accordingly, I think there's opportunity everywhere. Every market's a little bit different. So Phoenix is, growing by leaps and bounds. They had a lot of units um, come on of late, but it'll slowly die off over the next couple of years because so many projects have halted. But when you've got companies investing 40 billion or more in these chip factories and whatnot, they're spending a lot of money to figure this out. So you follow the money.
Absolutely. Absolutely. No, I think we're still in a good position. I think a lot of the numbers we see as well are looking at A-class properties when they talk about rent increases because of those new start, not the new, well, I guess the new starts and then the new assets that are coming live. In the C and B class, like it, what I'm seeing in my portfolio is we're still seeing rent increases pretty significantly.
Yep.
Maybe not what we saw last year, but still significantly more. And we're not seeing the decreases that are all over the headlines. So, yeah, very good. Well, yeah, I feel like I could talk a lot more here, but I certainly want to be respectful of your time. And I think you've already bought a bunch of value. So let's if we can kind of shift over to kind of the final 4 or 5 questions that I like to ask everybody. And maybe one that's a little bit different. If you had to do it all over again, would you have done the passive investing and then start with like a 40 unit, or would you have started bigger right out of the gates?
So originally I was thinking I had to do like 8, 10, 12 unit myself and kind of build up my resume.
Yeah.
But then I went to other real estate groups and they talked about partnering. And so that was my shift then. And I'm glad I did that shift because otherwise it would take me, much, much further along. But I should have gotten involved in these groups earlier and masterminds and whatnot, because real estate is a team sport and that sharing of knowledge. And even with my passive investments too, like you said earlier, finding a few operators that you can really know, like, and trust is so important. And I was kind of doing it on my own versus, getting advice from others and sharing resources would have really helped me.
Yeah, no doubt. And the community that you and I are involved in, I have learned, I've only been a part of that community for about 6 months, but I feel like the amount of education and experience that I've been able to gain from listening to those folks that are doing it at a much, much bigger level than I am, has really kind of 10x my education trajectory as well. So yeah, I agree. I can't stress enough, like getting around people that are doing what you want to be doing and then following their lead for sure. So, okay. So for the new passive investor, what type of resources, what type of guidance, what type of advice would you give to that person who's just getting into this space?
Yeah, do your due diligence on the operator. You want to there's a lot of investment groups out there. Get involved in an investment group. Um, I think there's a mentality of following others, like, oh, someone recommended this deal, and so you just jump in, and it's valuable to hear their viewpoints, but do your own due diligence as well. There's a couple deals that I jumped in because a friend recommended. I was trying to diversify into Bitcoin, into ground up development, and I didn't understand those deals that well, and those are the deals that I got screwed on. So
Sure.
make sure you understand what you're getting involved in, and look at it if it makes the most sense. And I didn't do the work. I relied on my friend, and he, I mean, no bad blood between us, but like I should have done more of my own homework.
Yeah, yeah. Shame on you
Yeah,
for doing that. Absolutely. And I've done the same thing. I've invested in deals because I see other people doing it. When it's, and I heard somebody once say, like, invest in what you know or understand.
yeah,
And if you can't understand it, you probably don't have any business investing in it in the first place. So I'm the same way with the crypto things and even development. I like the idea of development. I just don't know enough about it, what the risk can actually be to safely get into that space on my own. So, okay. Well, let's. I want to hear favorite book or podcast. I certainly want to hear about your book or have you share your book. But are there any other books that really influenced you throughout that process?
yeah. I think Joe Fairless's best ever book, I think, is a really good overview.
Yeah,
It's super thick but it's very easily digestible. I think for that beginning investor is a good one. Brian Burke um, yeah, has a good one. What's it called?
Hands Off Investor. Yep,
Yeah, that one I
yep.
haven't read, but people talk about it as one of the great books out there. So I definitely recommend that one as well.
Awesome, awesome. Any podcast that you're listening to hear about trends and economic stuff? Anything specific that jumps out to you there?
Yeah, I like the Walker and Dunlop podcast because they
Yeah.
really have some high end people like Peter Linneman. I've had him on my podcast before too, and just really high level stuff is important. And then I'll listen to depending upon the topic, a couple different podcasts here and there on sometimes cash flow connections.
Okay.
Hunter has some good economic people on there as well. But I just have my library and I'll just, that's a good topic. That's a good topic, so
Yeah. Yeah.
pick
Very
and
good.
choose.
Very good.
Yeah.
All right. Well, here's a couple of fun ones. Do you have a recent bucket list item that you've checked off your list or one you're hoping to in the near future?
Yeah. So we did a family trip. There was 10 of us that went to Alaska around July 4th. So half land, half cruise. And that was
Wow.
awesome. Salmon fishing. We were on a small plane, whitewater rafting, hiking. We did it all.
Awesome. Awesome.
Yeah.
Very cool. And a family of 10, that's more than just your direct family, I'm guessing.
Yeah, so we brought my parents, and they're getting up there in age, so it was great to have them come along to share it with them, and my sister and her kids. So
Oh, very nice.
yeah, so and
Bringing
we all
memories.
got along. It was all we had time to do our own separate things and then do things together. So
That's awesome.
that was definitely a great memory. And then a future one would be New Zealand has been on my list. It's supposed to be
Okay.
beautiful, a lot of hiking and just outdoor stuff. So I'm excited to do hopefully that within the next year and a half.
Okay. Yeah. If you're all the way down there, you might as well go to Australia as well, right?
I've done that a couple
Oh,
years
you
ago,
have.
and that was fantastic. Yeah,
It was. Okay.
yeah,
Yeah. No, that's definitely on my bucket list as well. Um, Probably too much to do in one trip, would you say, New Zealand and Australia, or
yeah. We did Australia in 2 weeks, and we were moving around.
you were?
But it was a great trip. I could share my itinerary offline with you.
Yeah, absolutely. Absolutely. All right. And then kind of my favorite one that I've been asking lately is if you were investing 100 grand today, and you couldn't put it in your own deal, I got to throw that out there. Where would you invest that 100 grand?
Well, multifamily value add, I think is a place to be. Now's a really good time to buy. There's such a tremendous need for housing. So just finding the right operator, I'm probably going to be the value add B class. That's why I know the best. I think it
Yeah.
protects you because you're adding value, but yet you're not going to have as much of the delinquency and whatnot with the C class, with the A class. If there's a lot of units coming on board, it might, you might have a really hard time leasing up. So that B class multifamily value, I think, is the place to be. I love Arizona. There's lots of good markets out there, but being with the right operator is the most important thing. Bet on the jockey.
I love it. I love it. All right. And so definitely, I want you, if you can, share with the audience about your current fund, because I think it's a great opportunity for the new or newer, even the seasoned investor to be placing some capital in your fund. So what kind of details can you share with us here today about that?
Yeah. So it's the BODC Multifamily Impact Fund. You can go to our website, breakofdaycapital.com. It'll take you to a link for that. You can watch a video on the fund, the property. We have facts on the fund. So yeah, 3 to 5 assets, value add multifamily in the Southwest markets where we've been focusing on for years. We don't do the shotgun approach. There's bonus depreciation. There's some cash flow, and it's about investing with a team of experts that focus on a few markets. And I think that's where you want to be.
I love it. I love it. And so you mentioned depreciation as well. So you've got a fund. You're going to be buying assets this year, so you'll be able to take advantage of the 80% depreciation this year.
Yeah,
Fantastic.
and what a lot of investors don't realize is you could still capture that 20% in the second year too. So you're still going to get your full depreciation. It's just not all up in the first year. So it's a great way if you could take advantage of it.
And I would even go so far to say is even if accelerated depreciation is not present, cost segregations still create amazing depreciation benefits in the space, even after we go down to zero. So, yeah, very good. Thank you for sharing that. You and I have talked a lot about that. I think it's a great investment opportunity. We've even talked about partnering on it, and who knows, that might still happen. But yeah, thank you so much. I appreciate all that you brought here today. You bring a unique perspective about this asset management piece that does not get talked enough about. So, Gary, thanks so much for being on the show. I really appreciate it.
Yeah, thanks for having me, Randy.
All right. And actually, one thing we didn't say is how can the audience find you, or what's the best place to get in contact with you if they do want to hear more about what you're doing?
Yeah, breakofdaycapital.com. We have a ton of investor resources as well. If you go to the tab, how to track your investments, how to find a good operator. But yeah, you could get our social media links. You could find out about deals. You get on our newsletter. That's the place to be.
Fantastic. Awesome. Well, thank you again, Gary. I really appreciate the time, and I think you brought a ton of value. Thank you.
Thank you.
All right. And to the audience, as always, thank you again for joining us today. As always, we like to encourage you to continue that education process, but more importantly than that, make the decision to take action and invest in your first passive investment deal. I am so confident that once you do, you will be, you'll just be upset that you didn't do it sooner. So reach out to Gary, reach out to myself, and if we can help in any way, we'd love to. So until next Thursday, thank you again for joining us, and we'll have another great show next Thursday. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.